aren't
Oh,
good at it,
hey
we'll
guys.
say.
All right, we are live today. If Lady wants to get us started, welcome to the BullHouse podcast on what is today, the 22nd of June. Lady, you want to do our special introduction?
Sure. Hey, everyone. Welcome to the BullHouse podcast. Today we have a special guest. It's Dr. Suzanne Trimbath. We are very excited that she's here and joining us. Dr. Trimbath, do you mind just kind of going over a couple of things about who you are, your experience, and with the markets and just in education with finances in general?
Absolutely. And thanks so much for having me on the Bull House, and especially with this, the broader aspect of all of my background, of being able to use everything that I know. So I actually decided at a very early age that I was going to study money. So I had originally thought I would be a doctor. When I was about 11, my parents sat me down and said they couldn't afford to send me to med school, so I should pick something else. So I decided that if it was about money, then I would study money. And so that was pretty much what I did. And all of my jobs, since I started working full time, have all been in finance. I worked in health insurance, typing checks to pay medical claims for Teamsters. I worked in insurance. I was an office manager for a Prudential field office. I was with the Federal Reserve Bank of San Francisco. I started out as a secretary, but I was marking errors, typographical errors in the newsletters that came out of the economic research department and sending it back to them. So when they had an opening for an editor, they hired me. I worked with the Pacific Stock Exchange. I worked with Depository Trust and Clearing Corporation in San Francisco, again with the Pacific Stock Exchange. I was with Depository Trust Company in New York. I helped build stock market post-trade projects in Russia, Egypt, Poland, Romania. All of that was with the U.S. Agency for International Development. And then I went to NYU to get my PhD in economics. I already had my bachelor's and my master's, and my whole career had been in finance. So when I graduated, I was hired by the Milken Institute to do research on capital markets, of course. And then I moved out on my own, and I've been doing independent research in economics and finance for about 20 years now, or maybe 15 years. So I want to say right up front that and everybody puts this on their Twitter profile, I'm not a financial advisor. I can't give you, I don't have a CFA or any of the certifications for financial advice. However, I have been teaching finance and economics since about 1989, which is a really long time. And my entire career was spent in that field. So as I answer your questions today, I'm going to be answering it from that perspective. Is that okay? Can we start from there?
That's wonderful. Thank you so much. It's such an impressive resume that you have. We're so honored you can join us to kind of shed light on different aspects of the market. Shark Bait, I think you were going to kick us off with a couple of questions. Do you mind starting that?
Yeah, absolutely. So once again, Dr. Trimbath, thank you so much for joining us here today. I know that the first time I had watched and seen any content from you was actually on the interview where you had with A. Tobit over on Superstonk. And I just loved how much that opened up people's eyes to the broader market in general versus looking at one specific stock. And I will say that in the spirit of that, so I'm actually a moderator there now as well, is seeing how much a content has evolved over time. Now people are looking at everything, they're digging through everything, and it's really amazing to see where it has evolved into. But some questions for you, just to dig in a little bit deeper. So, of course, we see that the market's extremely volatile as of the pandemic, and we see that there's tons of liquidity that's been injected into the broader market. So we understand that there's some level of risk with everything now. What would you suggest is a good rule of thumb for investing?
So the rule of thumb that I've carried with me since my first course in investments was never take on more risk than lets you sleep at night. The important thing that I think a lot of people miss is that risk and reward are equated. So as risk rises, so does reward. As the reward rises, as your rate of return rises, so does the risk that you're taking. So if someone offers you, a return on investment of 25% over the next 6 months, you need to be asking questions about the risk associated with that. It's really hard to, so as a rule of thumb, that's the rule of thumb. But there is something else called a life cycle investing, and that has to do with doing a serious examination of where you are personally, right, in your life cycle, right, in your life. So when you're in your 20s, 30s, even into your 40s, you're at a point where you can take more risk. If, for example, you put all of your investing money into one stock or 2 stocks or whatever it is, and you lose that money, you have time before you stop working to be able to rebuild, right? You can rebuild your wealth from that point. But by the time you hit 50, let's say, and these are rule of thumb numbers, right? By the time you hit 50, you need to be taking less risk, because if something happens to your investment portfolio, you're no longer in a position to be able to rebuild that from scratch, right? Your highest earning years are, generally speaking, rule of thumb again, are in your 50s and 60s. Those are your really big earning years. That's the point where if you're earning a salary or even working for yourself, as I have been, those are the years when you're going to have your highest levels of income. At that point, though, you don't have time, so you have more money, but you have less time, right, to rebuild. So time is also a factor in investment portfolios when you're looking at this risk-reward trade-off. And then eventually, once you move into retirement, then what you're thinking at that point is that you're not earning new income, right? So you have the investments that you've made, whatever pension you've earned, Social Security, whatever it is. And you have that to live on. And so you have to be much more conservative. So a rule of thumb is that by the time you hit retirement, whatever money you've been able to accumulate, whatever wealth you've accumulated to that point, that you're going to be spending down about 4% of that per year as you move into retirement. So the concept of risk reward, I think, is one that most people miss. Higher reward means higher risk. Lower reward means lower risk. So you take less risk, you sleep better at night, but you're not going to make 15% in 6 months or 25% a year. You're going to be taking a smaller rate of return.
Right. So I guess if you have more time to rebuild that wealth, you should be playing not necessarily riskier, but being able to try to go for these bigger plays, so to speak, in that case.
Right, bigger plays. And then again, rule of thumb, equity investments are more risky than bond investments, for example,
right,
or annuity investments, right?
So perhaps this is a good segue question in the sense that we currently see a lot of different types of investments being proposed to people. It feels like everybody's making money with everything now that we're on a crazy bull run since the start of the pandemic. And so everything from mortgages to crypto to just the regular stock market, it seems like you can make money everywhere. One of the major problems, and especially here in Canada, but this is a worldwide phenomenon, is that a lot of people will dump in all of their money into housing specifically. And so here we've reached mortgages that are on average about $1 million, which just seems a little bit unfathomable at this point. But what would you recommend in terms of the types of investments? Where would be a good place to park your money, if any?
Right. So housing is a really interesting. I did a lot of research on housing leading up to the last financial crisis. And at one point, I made a comparison between housing and gold. Housing, a new kind of gold, right, is what I called it. And the idea was not that houses are as good as gold, right, because gold holds its value, but that people were treating houses as if it were gold, right? So once you get to a point in the housing market where people are thinking more about, can I afford the mortgage, than they are, am I paying a fair price for the house, you're into a bubble. And what happens is when you have all of this infusion of liquidity into the market from the central banks, from the governments, from everybody just trying to support the economy through the pandemic, super low interest rates. In 2004, 2005, you could actually get an equity loan at a negative interest rate, right? So the bank would pay you to take this. How crazy that is, right? So housing certainly is one. It's more important to think about the value of the property that you're purchasing and are you paying a fair price, rather than focusing on, can I afford the mortgage? Because that mortgage comes about because you have these very low interest rates. And that really doesn't last. So like the different types of investments and what would be appropriate or like, what your options are. A lot of that depends on your answer to the last question you asked me, which is this risk versus reward. If you can, like housing I only studied the US market in housing. I didn't look at international, but from post-World War II until 2008, there had never been a period of time when nationally housing prices fell in the US. Nationally, and which they did in 08. Prior to that, the fall in the national price of houses, there were significant drops in the prices of homes in San Jose when the dot-com bubble burst in the early 2000s, right around 2000. There was a drop in housing prices in Houston when there was an oil bust, right? Oil prices bust. There was a drop in housing prices in Los Angeles when, at the end of the Cold War, most of the LA County's economy was based on the military-industrial complex. So when the Cold War ended, and when the government needed far fewer weapons and that sort of military-industrial spending, then there was a housing bust in Los Angeles. So, they say in real estate, it's always local, right? It always depends on, like, is your local economy sufficient to support that level of housing prices? If a mortgage is $1 million across the whole country, you can't really look at the economy across the whole country. You need to look much more locally, like within a county, right? Or a city or a metropolitan area to be able to determine if that's correct or not. I will say this about US housing market. We have had a shortage of housing for a very long time. California, for example, when I looked at it in the early 2000s, they were building 150,000 fewer homes than people were forming households. What's forming a household? Average household of, 2.1, one couple with 2-point-something children, whatever that number is. Each time as your population is growing, you need to be increasing your housing supply and demand, right? So if the demand is going to rise naturally as the population rises, then the housing stock has to rise with it. Otherwise, you get these increases in prices. Increases in prices right now are clearly driven by low interest rates and people thinking that this is my last chance to get in. There are other types of investments depending on your risk reward, right? So concrete assets certainly is one. It has inherently more risk, but it has a longer term payoff. So if you buy a house, that's like a 30-year investment, right? You're buying something that you're going to live in. Hopefully, you're not just flipping houses, which contributes to, stirring the pot. But that's that. So the three factors of that you take into consideration when you want to look at an investment is of course the cost, the interest rate, the risk associated with that investment, and the other one is time. How long are you going to be in this? There is no financial theory formula that I'm aware of that does not include time as part of the investment.
Right.
So time, so you have to think about how long am I going to be here? And that becomes part of the equation. Equities are higher risk than bonds. Bonds are higher risk than annuities. You can go through this whole spectrum of risk versus reward. As the risk rises, so does the payoff. And that's what makes equities attractive, especially to people under age 30, who have, who can tolerate more risk in their portfolio than, for example, someone who's already in their 50s.
Right. I guess kind of continuing on that kind of line of thought here when we start talking about risk, one of the topics that I wanted to bring up was revolving around ETFs specifically, and how much they've been marketed over the last decade or so as the end all to be all in a certain way. From my perspective, I feel like these have created a little bit of risk to the overall market because they're starting to tie together a lot of different industries together, that, and starts moving them simultaneously when one is struggling. Do you have any thoughts on the ETF type of movement that we're seeing now? And is it a good thing for the economy?
Well, it's not part of the economy. Okay,
Right.
it's part of finance. Finance is part of the economy. And finance is everywhere, right? It's becoming increasingly an increasingly important part of our overall financial markets. I mean, our overall economy. The amount of money put into it, the amount of money that people get paid for it, right? I mean, the economy, our livelihood, our well-being, everything is tied up in finance, right? So it's not wrong to say that, that it's part of the ETFs are part of the economy, but they're really just part of the capital markets because it is, in a sense, a derivative investment. An exchange traded fund that uses, for example, the Dow Jones Industrial Average, whatever money people put into buying shares of the ETF then goes out and mimics the proportion of the shares that are in the Dow Jones Industrial Average, right? So the Dow Jones Industrial Average, the Dow, this is what everybody watches for. How's the market doing? When people say the market's up, the market's down, they're talking about the Dow Jones Industrial Average, which consists of, the last time I checked, I think there were 30 stocks in there, and those 30 stocks are selected and sometimes changed so that they reflect the overall economy. And so the ETF is simply buying in the same proportion shares of, I'm not even sure what's in there now, Apple, IBM, Northrop Grumman, whatever it is. They're buying shares of those companies to mimic what's in the Dow. Okay, so that they should be able to go up and down with the Dow in general. That's basically what an exchange traded fund is. It's tied to some index. Generally speaking, they are not traditional and they're actually fairly new. But they are, you could, if you had the sufficient funds to do it, you could actually buy the same shares that are in the Dow, shares of the same companies that are in the Dow Jones Industrial Average, and you could actually then, purchase shares in that proportion and build your own. One of the problems with the ETFs has been that so mutual funds, for example, have been around since the 80s. And it was always believed that a mutual fund would never be worth less, a share of a mutual fund would never be worth less than $1 because basically every dollar was a share. But in 2008, we found out that that wasn't true. So there is risk in there. It should be less risk than buying one individual stock because you are not putting all your eggs in one basket. You're not buying just shares of Apple, you're buying shares of 30 different stocks. So that's diversification. And diversification in your investment portfolio is very important. Don't put all your eggs in one basket, right? I'm sure everyone's heard that truism. If you have whether it's an ETF or a mutual fund or any other type of fund that you put your money into, the advantage is that there's a professional managing that portfolio for you, right? So they do take some fees. It's usually hidden in the fine print, and there are some rules about how much they can and can't, but you want to find one that charges the lowest possible fees. The manager usually takes, the fund manager usually takes some percentage off the top of the earnings as their revenue. so that they're not costless, right? So even though it's a no load fund. In other words, you don't have to pay upfront to get into it. You just put in whatever shares you have. They do take fees out of that, something you really want to watch out for. They're not all the same by any means. And I think it's not, I mean, like I say, it's the difference between if you want to be in the stock market and you don't want to take the risk of one company, one individual stock, then the funds are one option to get around that individual risk.
Dr. Trimbath, let me ask you a follow-up question to that. So is it risk-based investing that you might have to kind of see which way should I invest? ETFs are safer versus mutual funds versus index funds?
Yeah, I mean, I think I don't really use that term risk-based investing, but risk is a part of every your tolerance for risk should be a part of every financial decision that you make for investing and saving. I don't know of a way to calculate the return on an investment without considering risk, but you absolutely have to understand that big rate of return comes with bigger risk. That's just the reality of investing.
Right. And then the last question from my end, at least, is in regards to taxes. And this is a pretty loaded question, but we'll try to stay as topical as possible. Is that, of course, we know that big corporations have ways to work amongst the taxes, sometimes, fully evade them if you see it that way. In what ways can the individual investors attempt to also work with taxes in regards to capital gains specifically?
So I'll pass on a little advice that my CPA gave me probably 10 years ago when I asked him whether or not I should be looking for tax-exempt income in my investments. He said, first you have to get some income. So the question of managing your tax burden has a lot to do with how much money there is. I mean, the first thing is you've got to make, you need to get your returns up. Price averaging is one way to deal with some of that because then you can, so the idea is that you, let me see if I remember this rule of thumb, you want to defer your gains and advance your losses, right? So if you know that you're going to take a loss on a particular investment and you, and this is just basic, college accounting, and you made quite a bit of money this year, you take the loss this year to be able to write that off against your taxes this year. If you are making a lot of money on an investment, you want to defer that to next year, right? You don't want to take that gain now, you want to take it next year, because next year you could be in an entirely different tax situation. So rule of thumb, advance your losses and delay your earnings. That's one way to deal with it. The other one is that, municipal bonds, fairly safe investment. Some of them pay fairly decent rates of return. I think depending on the risk that the country is having or the state, Puerto Rico, for example, had some, in the last year or so, had some really serious financial issues. And so their bonds were paying about 11%. Some states, not all states, of course, issue bonds, but most municipalities do. Rule of thumb, if your marginal tax rate is 35% or higher, you should be in muni bonds where you're getting tax-exempt income. So there's a lot of things. This really, the managing the tax burden really comes down to, other than the rule of thumb, these rules of thumb that we're talking about, it really comes down to what jurisdiction you live in. So for example, there are some states that have no income tax. There are some states that don't tax retirement income. Every jurisdiction is different. And so, the only other rule of thumb I could think of is that you are able to exclude from income and I think this is still true after the 2017 tax changes in the states, you are able to exclude some percentage of your corporate dividend income from your taxes as well. Other than that, again, those are just rules of thumb. Other than that, it's really very personal and very specific to where you live.
Right. I especially like using those losses strategically as well, to potentially for your benefit on tax season. I never personally really thought about it that way, but it makes a lot of sense.
Well, sure, as a result of that, there's something known as a January bounce. So a lot of the smaller stocks of the smaller companies, not the IBMs or whatever,
Yes,
Apple,
yeah.
but the prices tend to jump up in January because people will sometimes sell it in December, recognize the tax loss, and then buy it back in January. And so statistically speaking, there are some stocks that just typically have a bump up in January because people are replacing what they sold. So they bought it whenever they bought it. They see that they're at a tax loss. They still want to hold the stock, so they sell it in December and buy it back in January.
Clever. I love it.
Mm-hmm. Yeah.
Lovely. Thank you so much. I'm going to pass it off to the next speaker here.
Okay.
Yeah. So, Dr. Trimbath, you've alluded to this already a couple of minutes ago, with a change in investment strategy that young people have to follow versus old people, building wealth versus maintaining wealth in a sense. So especially seeing how we have a younger audience, how or what would you say would be the must-knows in your book when you plan to go into the stock market to do some investing?
Right. So just let me clarify a little bit. It's not necessarily about age. It's about life cycle. So when I say, 30 and 50 and things like that, those are just generally speaking when people enter the labor market, when people exit the labor market. Some people retire much earlier, some people work much longer. So it's not just about how old people are. It's about where you are in this life cycle. Where are you in your earning cycle, right? As to what you would do. Must knows in my book, not my book, but because my book's not about investing, right? I don't write books about investing. I teach finance and economics, and so I see a lot of this. But I think the first thing that you have to answer is that that part A for yourself, like what's your risk reward profile? Where are you in this investing life cycle? And since people are, as you said, your audience can be quite young. They're tempted to go into more, they're certainly in a person who's just starting out their investing career and has, a long earnings, a long cycle ahead of them for earnings, is certainly in a position to take more risk. But some of these things require a really advanced understanding. So I did a book back in 2003, I think it was, called Beyond Junk Bonds. And in it, we did the entire explanation of how structured securities are put together, which turned out to be mortgage-backed securities, credit default swaps, all that sort of thing. So you can go as far into that as you want to. I will tell you what Warren Buffett says, invest in things that right? So if you want to study options, right, then you need to know something about the options pricing model. That's Black-Scholes. And you need to understand that model was derived from heat transfer. That wasn't a purely financial economic model. Once you understand these nuances, then I think that these are certainly represent opportunities, high risk, high reward opportunities for individuals who are willing to put in the time and effort to understand them. From the most simple model is that the price of the investment, let's take for an example, an equity security, a stock. The price of that should be equal to the present value of the discounted stream of future revenues. What does that mean? That means that a company that pays dividends, for example, GameStop is one exception, they don't pay a dividend. In fact, Warren Buffett's company, Berkshire Hathaway, they don't pay dividends, and yet the company is, $100 and something thousand per share, right? So, but just in general, if you take so do you understand the time value of money? Is this something I should talk about a little bit?
Time value in what regard exactly?
Well, the time value of money. So $1 today is worth more than $1 tomorrow.
Yes. It's a very important correlation. We should probably talk about that. Yes, Dr. Trimbath.
Yeah, so let's talk about that a little bit, because as we said earlier, time is in every calculation that you make in finance. You have to have time in there. So $1 today is worth more than $1 tomorrow. Why? Well, first of all, inflation. Inflation is there has not been deflation in your lifetime. There has been in mine. We had deflation in the 70s, where prices actually fell. The Federal Reserve in the US hates deflation. So they keep trying to keep this. That's why they have like a 2% inflation, right? But they always want the value of that dollar going up. So, or the value going down while the prices go up. So, as prices are rising, then what I can get for $1 today is more than I can get for $1 tomorrow, because the prices go up tomorrow. So tomorrow I can only get 0.75 of whatever I could get today. So that's one. There's also another element of time risk, which has to do with the risk of loss. So the longer the loan is out there, the more likely that someone will default on it. I lose my dollar, there's a hole in my pocket. I don't know, something I put the dollar into some stock today or some investment today, and that investment fails, right? So time adds risk, time adds, so when I talk about the discounted value, the present value, I'm talking about taking into consideration this idea of time value of money. So the present value is of $1 that I get next year is less than the value of $1 that I get today. Why? Because when I get that dollar a year from now, prices will have gone up and I won't be able to buy as much with it. And there's a possibility that you won't have the dollar to get back to me, right? So there's that risk. So the present value of this stream of future revenues means that I look at, for example, typical stock. I take the stream of dividends I expect to receive from this on this stock and again, here's another piece of math that goes in all these financial decisions. Time goes to infinity in all of these models. There are truncated ways to do this, 1/1 minus r, etc. Very simple formulas you can use, but you do have to have an understanding of what that is. So let's say that you take you use one of these factors to figure out what that stream of dividends is worth today, and that's what you should be paying for the stock. So when you see like a price earnings ratio, when you see a beta factors on Yahoo Finance or Finance Yahoo, all of that is taken into consideration. The idea that what should the price of the stock be today? Rule of thumb: the price of a stock, the price earnings ratio should be around, usually like 15 is really, you're getting into a risky end of things, but the markets do tend to fluctuate based on sentiment, sometimes more than the actual facts of the finances of the company. So these kind of like, for me, the must know is what's my risk reward profile? How much risk am I willing to tolerate? I've always been a suspenders and a belt kind of gal, so I don't tolerate a lot of risk. Where are you in your investing life cycle? If you have money to burn and you know that you're going to make 10 times that next year or the next 10 years, then you can take a lot of risk and be prepared for getting some really good returns. The riskier investments there's certainly plenty of them out there, and they are becoming more widely available to individual investors as we move forward in time. But the other one is know what you're investing in. Students ask me all the time, "You're an economist. What sort of stock should I buy?" And I tell them, "Well, what kind of cereal do you eat? What brand of sneakers are you wearing? What brand of television do you have at home?" All of those companies, right, most of them are publicly traded. I could buy shares in Chevron. And every time I went to the gas station, because let's say I always use Chevron gasoline, and every time I went to the gas station and filled up my tank, I would, in a sense, be paying myself, because some part of that revenue that Chevron gets from me buying that gas is going to come back to me as a dividend, right? So when I say invest in what you know, if you want to get started just like right from scratch and you want to go right into equities, that's what I tell students all the time. What are the companies that you're already buying their stuff? You're already giving them money. Let them give you some money back. Let them give you some dividends back, and let you also benefit from any growth the company has that would be reflected in the price of their stock.
I love that you touched on that, because my husband and I, we have a 2-year-old, and for the longest time we joke with the formula that we'd have to buy. We're like, man, we should really buy stock in this. Eventually we did, and we did cash out on our stocks recently for it, because we're no longer buying formula. But I do love that, because it's something that we believe in too. If you're gonna go to a company and buy their products or shop there or whatever, you really should invest and pay yourself back at least a little bit. I love that. Thank you.
Yeah, you're welcome. You're welcome. That's what I say every time you spend money, at that company, you're basically paying yourself some money back, right? Because it's going to come back to you in the dividend. Yeah, that's, for me, if I were like at ground zero, and I didn't know anything about investing, that's exactly the thought I would have with the thing that Ken had just said. I would do that.
Now, speaking of dividends, obviously, we all have seen the recent trend in social media, at the very least, that there have been some YouTubers, especially, that promote trading as opposed to investing, in a sense, with different stocks. Do you see this as a rather dangerous trend, or do you think that people should be aware of this and subsequently maybe at the risk of going into the market under false impressions, take that risk, in a sense, to trade stock instead of investing into them?
Yeah, and I wouldn't call that a trend, because day trading has been around for a really long time, ever since probably I was in the 80s, maybe even earlier. I wasn't aware of it before that, but let's say in the 80s, 70s, or 80s, day trading became a thing, right? Started then when was Schwab offered discount rates for trades, like per trade. It used to be like $35 a trade, at which point, and that's when I started investing in stocks, it cost me $35 a trade to get in. So I had to think about that $35 up front as part of what's my return going to be. And then eventually there was, no fee trading. So my bank offers me a trading account, a no fee trading account. If I wanted, I can trade so many, so many shares of, or I can make so many trades a month for free, right? So it's not a trend. It's not new. It's been around a long time. My personal opinion is that it's casino. It's a casino, right? That's casino capitalism. That is what, when I went to Russia to try to help them make the transition from communism to capitalism, that's what they think we do all day long. That's what they think the New York Stock Exchange is all about. It's a casino. It's just about gambling. If you have all day to sit and watch stock prices and do analysis and watch that ticker and understand exactly when you want to buy something, when you want to sell something, and you want to do that, people do that and are successful at it. It's risky. It's not risky if you can watch it all the time, right? I don't think I ever actually did it myself. I'm a bit of a nerd. Okay, so let's be honest about it. Before I picked a stock the first time, there's something called the Dow theory forecast, and I would go to the library and I would read through these forecasts of all this analytical information about the company, about the prospects, about the prices, about the dividends, the stream of earnings, whatever they're out, all their industry. I would compare that company to the industry it was in to see how, if that was a good investment, and then I would buy shares of the stock. So I never did it myself. I think that it's, certainly people enjoy it. It's not new. It's not a trend. It looks new because it's on YouTube, and YouTube is new, but day traders have been around for a long time. And again, you want to think about time as part of your investment, but also what's the cost of getting into the investment. And now that you have all of this costless trading, right, where you can trade for free, what you should be thinking about is, how is it possible that a brokerage firm offers me free trading when I thought that was a service they were selling? And the answer to that question is too complicated for this afternoon, but it's certainly something to think about. I don't like it because it makes a casino out of what should be a capital market where entrepreneurs with really good ideas can go and raise the capital, raise the funds that they need to be able to build this, whatever, this widget, this app, this, this product or service that people want and need. And as long as it's this sort of casino capitalism going on, entrepreneurs, I think, wisely would be timid about going into those waters.
Casino is a very interesting topic that you brought up, because especially if I personally start looking at all the kinds of derivatives that have emerged over the last decade or so, there certainly is still the fundamental part about the stock market, deciding to buy into a company because someone believes in their product or believes in their capacity to reform the business in a sense. There have been so many leverage products popping up lately, ranging from turbo knockouts to warrants to all kinds of derivatives. But let's take this moment here to talk about options in a sense. Especially with the trend on Wall Street bets, I personally believe that there has been some promotion for options going on. And in terms of making money on that, or perhaps also using them for their, in my opinion, intended purpose of hedging your bet on any given stock, would you actually recommend reading into options for the general investor, or is it just a topic that needs so much information or time to get into that it's generally not worthwhile for the average investor to get into?
Yeah, options are another one of these financial innovations that was created with good intentions, but ended up being very badly used. I started looking at, started studying options models and structured securities, when I got out of grad school and was working at Milken Institute, and did a lot of, looking into the guts of it for the Beyond Junk Bonds book. At a minimum, I think you need to understand that options, again, so the way that you're describing options are kind of taking a leveraged gamble that the price of the underlying asset will go up or go down, rather than using it. The right way to do that is to use it as a true hedge. You have an investment in an actual asset, and you can use the option to manage the risk profile. And that's what all the derivatives do. Futures, options, all the derivatives do are to allow you to manage that risk reward profile. So rather than holding all of the risk of the underlying asset, you're able to leverage it one way or the other by using the option, because the option requires a very small cash up front, has the potential to be a very big reward in the back. That said, let me give you an example of a real abuse, a real problem that came about. Do you remember last summer when the price of oil went negative?
Yeah, that certainly was a most interesting topic. As far as I'm aware, even Bloomberg did a piece on that.
Right.
When
So
oil went negative. Yeah.
all right. So what happened was people were holding options, futures options for oil at a certain price. And when the option matures, right, when the derivative matures, they were required to take possession of the oil. They anticipated the price going in a different direction. They would be able to sell the option because the option, they could sell the option for more money than they paid for it, but less than the cost of oil. And so someone who wanted oil would then take that underlying asset. What happened was nobody wanted the oil. And so the price went negative because then you had to pay someone to take that oil, right? So when you look at options and all the derivatives, understand that there is an underlying asset at play. And that's, the reason that you use the derivatives and, all these other sort of, when you talk about hedging, you should be hedging some risk that you have. And if, for example, your risk is that you need oil, let's say you're Chevron, and you have to have, X million barrels of oil every month to keep your gasoline factories running. So you want to hedge your risk by buying some options for future prices. If you think prices are rising, you want to try to lock in a lower price so you can get that oil in the future at a lower price. But always remember, there is an asset under there. And if you have no economic interest in the underlying asset, then you should not be buying the option. That was the purpose of creating that financial innovation, was to be able to help companies that need wheat, or companies that need to sell wheat or oil or whatever it is, that they would have a way to manage the risk associated with price changes.
Yeah, well, I was actually following the situation in a sense on Wall Street Bets at the time, even though I was not necessarily active in the market. I can still vividly remember a post about someone actually getting a hold of one of these oil futures that had physical delivery included in them, and was panicking about whether he really had to take the X 1,000 barrels of oil actually, and how he would be able to sort of store them away. So that's also another thing that was really interesting to me, is to see that someone actually does not know the underlying of a derivative, but only cares for the potential of money being made, which sort of reflects the current sentiment that has been going on social media, the trend towards more risky investments, high risk, high reward kind of situations. But staying on the topic of derivatives for a quick second here, there is also the kind of less riskier investments, for instance, bonds or notes. However, they do not necessarily return as much, but offer a sort of hedge against the company in a sense. For bonds, for instance, if the company should go bankrupt, you usually get preferred in terms of payout earlier than equity, or with notes, you usually have a hedge against the downside and the upside for any given underlying index, for instance. With that much complexity added to the market, however, would you say that those are generally a thing to a different avenue in a sense to look into for the investor to get started?
Yeah, I think it is. And you really hit the nail on the head. It's about that risk reward profile. So bonds, notes, debentures, et cetera, those are all debt instruments. And this is looking at it from the corporate finance side, from the company's perspective. One is debt and the other is equity. So with debt, yes, you get a seat at the bankruptcy table in most countries, for example, France, bondholders do not get a seat at the bankruptcy table. When I say a seat at the bankruptcy table, the company goes into bankruptcy, they go in front of a judge and they present their financial situation, and then all of their debtors get together, their creditors all get together, and they get to say something to the judge about how we think the assets should be divvied up. So when I say at the table, I mean at the creditors' table. So bondholders, debt holders get a seat there, and whatever happens to the company, and let's say it's a liquidation type of bankruptcy, then, depending on this worked out in the court of law, there is opportunity for them to get some money out of that. On the other hand, if you're an equity holder and the company goes into bankruptcy, you get nothing, right? Because all you had was the value, right? The value of whatever that share of stock was worth. The value, the added value, what you get instead, if you will, instead of a seat at the bankruptcy table is, a claim on assets, which is what debt holders get, is that as a stockholder, you get access to dividends. So you get this stream of income coming in through the dividends, and you get the say in corporate governance in most countries, right? So part of the question is should you go into the debt as is buying the bonds of the company a hedge against them going into bankruptcy and you losing the money put into equities? Yes. Is it a dollar for dollar trade-off? I don't think so. And that would be an individual company. You'd have to analyze an individual company's profile to see that. They are, since bonds are on the lower risk end of the spectrum, some companies are high yield, high risk, what I call high yield securities. You can buy bonds of companies that are already near bankruptcy, that maybe they have a chance to come out of it, and that bond will pay an exceptionally high yield. When it was issued, maybe it paid, 5%, but as the company goes into financial difficulty, the price of the bond will fall. So bonds are a little funny in the sense that, they're a little different than stocks. So as the price of a bond falls, the percentage yield goes up because the interest payment is always the same. So if a company issues a bond for $1,000 and they pay 10% interest, that means that they pay $100. Did I do that right? 00. Let's say it's a $100 bond. They pay 10% interest, so they pay $10 in interest every year. And when the bond is issued, it sells for $10 or for $100 rather. But if the company gets into financial difficulty, the price of that bond could go to $50. However, you still get $10 in interest every year. But now your rate of return is 20%, not 10%, right? So that return reward really changes when you have bonds as compared to equities. So there are, look, even in the bond, a company's bonds, you can still have high risk, high reward, low risk, low reward. The bonds of, trying to think of a company that has really low risk right now, like Walmart, probably because they did so well. All of the grocery stores did so well during the pandemic. So their bonds would probably not pay a lot of interest, but they would not have a lot of risk, right? So there's a trade-off there as well. It's not a dollar for dollar trade-off between changes in the equity price, but the reality is that if the company goes bankrupt and goes into liquidation and the stock price goes to zero, the bondholder has the opportunity to see some returns through bankruptcy courts and settlements.
Most certainly. Unfortunately, it would appear as if we've run out of time right now. So, unless there are any objections, I'd like to thank you for answering our questions, Dr. Trimbath. Obviously, we would have a lot more, but we do not necessarily want to strain your time here. So, thank you very much for coming around.
You're very welcome, and it was a pleasure to be here, and I really enjoyed being able to respond to these types of questions for your group.
Well, thank you so much, Dr. Trimbath. And I mean, I'm going to reach out to you and connect with you here shortly, but maybe we're work something out if you have free time to do like maybe a part 2 to continue on our discussion that we had planned, because I didn't realize how long it would take. That's okay. Because you did such an amazing job and really thoroughly answered those questions. So we really appreciate it. But we'll be in touch. And again, thank you so much for joining us on the BullHouse. We appreciate it.
You're very welcome, and good luck with all of your activities and projects and adventures that you have going on. In terms of, I know you're on Discord and YouTube and Twitter and lots of things going on. So, and also, I guess Sharkbait, you said you're also on the Superstonk, I think.
Yes, that's right.
Yeah, some of you are on various Reddits and subreddits. So yeah, good luck with all of you on all of that, and never stop learning.
Absolutely. And just a final plug here for Dr. Trimbath. For everybody who's listening in, Dr. Trimbath has some fantastic books out there as well on Amazon. I personally had read through Naked, Short, and Greedy, which was a really eye-opening read. I highly recommend those as well.
Yeah, thank you. I'm Googleicious, as they say. If you Google my name, I'm usually the first one that comes up.
That's right.
That is amazing. I wanted to say thank you also. I know we didn't get the chance to talk too much, but hopefully we can do a part 2. It'll be my chance to ask questions.
Okay.
Thanks, everyone.
All right. Thanks.